So, what happens when you take a timeless investment philosophy, like, say, Warren Buffett's, and apply it to a super modern tech company? That's exactly what we're going to do today. We're putting microchip technology under the Buffett microscope to see if it makes the cut.
So the big question is this: is this a Warren Buffett stock? Does a company like Microchip, which makes all these tiny, complex parts for our digital world, actually fit the mold of a classic Buffett investment? Let's find out.
Okay, let's just cut to the chase. The verdict? Yeah, it's a wonderful company. But, and this is a huge but, Buffett's full quote is a wonderful company at a fair price. And that second part? That's where things get interesting. That distinction is, well, it's everything.
Which brings us to our final recommendation: a hold. Not a buy, a hold. And that right there is the big puzzle we're going to solve today. I mean, why on earth would you just hold a company you've just called wonderful? Let's dig in and see why.
All right, first things first, we have to understand why it's a wonderful company. And if you're looking at the world through a Buffett's eyes, that always starts with one thing: the business moat. And yeah, you can think of it just like a moat around a castle. It's that durable advantage, that big protective barrier that keeps all the competitors at bay and keeps the profits safe inside. For Buffett, this isn't just a nice feature to have. No, it's the absolute number one thing he looks for. So what about Microchip's moat? Well, it's built on three really strong pillars. First up, they have super high switching costs, which basically locks their customers in. Second, they're like a one-stop shop for their customers, which is incredibly convenient. And third, you put those first two together, and what do you get? You get some serious pricing power. Let's unpack each of those. Okay, this idea of switching costs is absolutely key. Imagine you're a company and you design one of Microchip's products into your brand new smart toaster or the dashboard of a car. To switch to a competitor's chip now, oh man, you'd have to rewrite tons of complex software. It's crazy expensive and takes forever. It's kind of like trying to switch your phone from Apple to Android after you've already bought $1,000 worth of apps. It's just a massive pain. And that's what locks in their customers. And look, the proof is right here in the numbers. We're talking about a gross margin between 60 and 65%. Think about that. For every single dollar of stuff they sell, 60 to 65 cents is pure gross profit. That is a massive signal of pricing power. It means they can charge a premium and their customers will pay it because switching away would cost them even more.
Okay, so the business itself is great, but you know what can sink even a great business? Bad management. So for our next check, we've got to look at the people running the show. Are they making smart moves with the company's money? And are they really looking out for shareholders like you and me?
And what you find is that Microchip's management team has this incredibly disciplined playbook. It's almost like a formula. First, they pour money back into the business to keep it strong. Then they use cash to pay down debt from smart acquisitions they've made. And only after those two things are done do they return cash to shareholders. And they do that through a dividend they've been growing for over 20 years, plus share buybacks. It's just a super rational, shareholder-friendly way to operate. No empire building here. So, a great moat plus smart management, that should equal some pretty amazing financial results, right? Well, let's move on to part 3 and see if the numbers actually back up this story. First up, let's look at return on equity, or ROE. Basically, this just tells you how good the company is at making profits with the money shareholders have invested. Now, Buffett likes to see at least 15%, which is already a pretty high bar. Microchip, they almost double that, coming in at a massive 29.7%. I mean, that's just a screaming sign of an incredibly efficient, profitable business. Okay, so the company does have some debt on the books. A lot of it came from making those smart acquisitions we mentioned, but the big question is it a problem? And this number, the interest coverage ratio, gives us a very clear answer. Nope, not at all. It means the company's profits cover its interest payments more than 10 times over. So yeah, that debt is very manageable. And now we get to the holy grail for value investors like Buffett: free cash flow. This is the real, actual cash left in the bank after all the bills are paid and the business is run. And Microchip is a machine, consistently cranking out over $2.5 billion of it every single year. You know, this is the fuel for everything. It pays for the dividends, the stock buybacks, future growth. It's just a huge strength. All right, so we've pretty clearly established that this is a wonderful company. No question about it. But that's only half the battle, right? Now we get to the single most important question you can ask as an investor. What's it actually worth? And what price are we being asked to pay for it? And this is where we get to the absolute heart of Buffett's philosophy, the margin of safety. The idea is so simple but so powerful. If you calculate that a business is worth $1, you don't pay $1. You wait. You wait until you can buy it for, say, 70 cents. That 30-cent difference, that's your margin of safety. It's your buffer in case you're wrong or in case bad luck strikes.
So how do we figure out what Microchip is worth? We can do a pretty simple calculation called a discounted cash flow analysis using some really conservative assumptions. Let's say that massive free cash flow grows at just 5% a year for the next 5 years. And let's say we want a 9% return on our money for taking the risk. See, we're being deliberately cautious here, trying to build that margin of safety right into our numbers.
And here it is, the moment of truth. When we run those conservative numbers, we get a fair value for Microchip somewhere between $95 and $115 a share. And what's the stock price today? It's trading right smack in the middle of that range. So what does that mean? It means the market is pricing it, well, fairly, but it's not offering us any kind of discount. There is no margin of safety.
Okay, let's wrap this all up. We've looked at the business moat, the management team, the financials, and finally the price. So what's the big takeaway here?
It all comes down to this, which is really the core of value investing. It's a simple two-part test. Part 1, find a wonderful business. Part 2, buy it at a great price. You can't just pass one part. To really win, you have to pass both. And let's be clear, Microchip aces the first part of that test. I mean, with flying colors. It has a powerful moat, it has rational management, it has absolutely superb financials. It is, without a doubt, a wonderful business. So part 1, big checkmark. But here's the rub. At its current price, there's just no margin of safety. It's a fair price, not a great price. And because of that, it fails the second part of the test. And that part is just as important as the first. And that leaves us with one of the most classic dilemmas in all of investing. What's more important, finding a great company or finding a great price? When you find an A-plus company that's selling for a C-plus price, what's the right move? Well, the discipline of value investing teaches that you have to be patient. You wait. Because the real magic, the real secret to long-term success is getting both.